What I'm about to reveal will fundamentally change how you think about higher education, student loans, and the financial trap that has destroyed the economic future of an entire generation. College isn't an investment in your future, it's a predatory lending scheme designed to create permanent debt slaves who will spend decades paying tribute to banks and universities while never building real wealth or economic independence. This isn't about the value of education or learning. This is about how the American higher education system has been deliberately transformed from a pathway to the middle class into a debt extraction machine that enriches banks, university administrators, and government agencies while destroying the financial prospects of students who believed they were investing in their future. By the time I'm finished explaining how this system actually works, you'll understand why student debt has increased 1,200% since 1980 while wages have remained flat, and why an entire generation of Americans has been financially crippled by a system designed to extract maximum profit from their desire to improve their lives through education. Let me start with Jessica Martinez, a 32-year-old social worker from Phoenix who graduated with a master's degree in social work in 2014. Jessica believed she was making a responsible investment in her future by getting an advanced degree in a field dedicated to helping people and making a positive impact on society. Jessica's total student loan debt when she graduated was $89,000 for her undergraduate degree and $38,000 for graduate school. She was told by financial aid counselors that this was a reasonable investment because social workers with master's degrees typically earn $50,000, $60,000 annually, and loan payments would be manageable on that salary. But the reality has been completely different. Jessica's starting salary was $42,000, and 9 years later, she earns $48,000. Her minimum monthly loan payments are $1,247, which represents over 30% of her take-home pay. Despite making every required payment for 9 years, her loan balance has actually increased to $139,000 due to interest accumulation. Jessica lives with roommates, drives a 15-year-old car, has no savings, and has postponed having children because she can't afford the additional expenses. The education that was supposed to improve her financial prospects has instead made financial stability impossible, trapping her in a cycle of debt that grows larger despite her consistent payments. Jessica's story isn't unusual. It's the predictable outcome of a system designed to create permanent debtors rather than educated professionals. But what Jessica doesn't understand is that her financial destruction wasn't an accident or bad luck. It was the intended result of policies deliberately designed to extract maximum profit from students while providing minimal economic value. In return, the student loan industry generates over $120 billion annually in interest payments, making it one of the most profitable lending sectors in the American economy. But unlike other forms of debt, student loans are designed to be nearly impossible to escape. With legal protections that ensure borrowers remain trapped in debt for decades, student loans cannot be discharged in bankruptcy. Unlike credit card debt, medical debt, or even gambling debts, this means that no matter how financially devastating student loans become, borrowers cannot get relief through the normal legal mechanisms that exist for other forms of debt. This bankruptcy protection was deliberately created by Congress at the request of the lending industry, ensuring that student loans remain profitable even when they destroy borrowers' financial lives. The industry lobbied for these protections by claiming that students would abuse bankruptcy to escape debt. But the real purpose was to eliminate any possibility that market forces could discipline predatory lending practices. The government's role in creating and maintaining this debt trap reveals how deliberately the system has been designed to benefit lenders at students' expense. Federal student loan programs don't just guarantee loans, they actively encourage maximum borrowing through policies that make debt appear deceptively affordable. Income-driven repayment plans, marketed as helping struggling borrowers, actually extend loan terms to 25 years while ensuring that monthly payments often don't cover interest charges. This creates a situation where borrowers make payments for decades while watching their debt grow larger, creating permanent debt slavery disguised as payment relief. The Public Service Loan Forgiveness Program, which promises debt relief for government and nonprofit workers after 10 years of payments, has rejected over 95% of applicants due to bureaucratic requirements that were deliberately designed to make forgiveness nearly impossible to obtain. These programs aren't designed to help borrowers, they're designed to create the illusion of help while ensuring that maximum debt remains profitable for as long as possible. But the most insidious aspect of the student debt scam is how universities have used guaranteed government loans to inflate prices artificially while reducing educational quality. When the government guarantees that students can borrow unlimited amounts for education, universities have no incentive to control costs or provide value. College tuition has increased 1,200% since 1980, far outpacing inflation, wage growth, and every other sector of the economy. This isn't because education has become more expensive to provide, it's because universities realized They could extract unlimited amounts from students who were encouraged to borrow whatever amount universities chose to charge. The additional money hasn't gone toward better education or more professors. Instead, it's funded massive expansion in administrative positions, luxury amenities, and executive compensation that have nothing to do with learning. Universities now employ more administrators than professors, with many institutions spending more on marketing and student services than on actual education. Meanwhile, the quality of education has declined as universities focused on enrollment numbers rather than educational outcomes. Classes are larger, taught increasingly by adjunct professors without benefits or job security, and designed to maximize revenue rather than learning. The for-profit college sector represents the most extreme example of educational exploitation, with companies like University of Phoenix, Corinthian Colleges, and ITT Technical Institute generating billions in profits by targeting vulnerable populations with expensive programs that provide minimal job market value. These institutions specifically recruit veterans, single mothers, and first-generation college students, using aggressive marketing tactics to convince them that expensive vocational programs will provide economic opportunities that traditional employment cannot offer. But graduation rates at for-profit colleges are typically below 30%. Job placement rates are often fabricated, and graduates frequently earn less than people with high school diplomas, while carrying debt loads that make financial stability impossible. When these institutions inevitably collapse due to fraud investigations, students are left with worthless degrees and non-dischargeable debt for education they never received. But the executives and investors who profited from these scams rarely face consequences, while students remain financially destroyed for decades. The community college system, which should provide affordable alternatives to expensive four-year institutions, has also been co-opted by the debt creation machine through policies that encourage students to borrow for living expenses and transfer to expensive four-year schools. Students who could complete valuable career training programs at community colleges for a few $1,000s are instead encouraged to pursue bachelor's degrees that require borrowing tens of thousands of dollars for credentials that often provide no additional job market value. The professional licensing requirements that supposedly justify expensive degree programs are often created by industry groups seeking to limit competition rather than protect public safety. Many jobs that require college degrees today were performed effectively by high school graduates for decades. Before artificial credentialism created barriers to employment, this credential inflation has created a system where students must pay for expensive education to qualify for jobs that don't actually require advanced education, generating profits for universities while creating unnecessary debt burdens for workers. The private student loan industry has also expanded to fill gaps left by federal programs, often with even more predatory terms and fewer consumer protections. Companies like Sallie Mae, Navient, and Wells Fargo have made billions in profits by offering loans with variable interest rates, limited deferment options, and aggressive collection practices. These private loans often target students who have exhausted federal borrowing limits, encouraging them to take on additional debt with worse terms to complete degree programs that may already be financially unsustainable. The loan servicing industry, which manages repayment for both federal and private loans, has been repeatedly found to engage in practices designed to maximize borrower costs while minimizing payment application to principal balances. Servicers routinely misapply payments, provide incorrect information about repayment options, and use bureaucratic obstacles to prevent borrowers from accessing programs that might reduce their debt burdens. But what makes the student debt scam particularly devastating is how it affects borrowers' ability to participate in the broader economy. People trapped in student debt cannot buy homes, start families, or make the consumer purchases that drive economic growth. This creates a deflationary spiral where student debt reduces economic activity, leading to fewer job opportunities and lower wages for everyone, including people without student debt. The debt burden on young adults affects the entire economy by reducing demand for goods and services. The homeownership rate among young adults has plummeted largely due to student debt, which affects credit scores, debt-to-income ratios, and available cash for down payments. This has contributed to the housing crisis by reducing demand from first-time buyers while forcing more people into expensive rental markets. The psychological impact of permanent debt is also severe, with student borrowers reporting higher rates of depression, anxiety, and suicide ideation compared to people without educational debt. The stress of owing money that can never be eliminated creates chronic psychological pressure that affects mental health and life satisfaction. Many borrowers report feeling like they've been betrayed by the system that encouraged them to pursue education, experiencing shame and self-blame for financial problems that were actually created by predatory lending practices rather than personal failures. The international comparison reveals how deliberately exploitative the American system has become. Countries like Germany, France, and Norway provide high-quality, higher education at minimal cost to students, proving that expensive tuition is a policy choice rather than an economic necessity. These countries invest in education as a public good that benefits society rather than treating it as a commodity that students must purchase through debt financing. Their graduates enter the workforce without debt burdens, allowing them to contribute to economic growth and innovation rather than spending decades paying off educational loans. The American system's focus on individual debt financing rather than public investment reveals how higher education policy has been captured by financial interests rather than educational or economic development goals. But the student debt crisis also serves broader political and social control functions by creating a population that cannot afford to take economic risks or challenge existing power structures. People trapped in debt cannot afford to start competing businesses, engage in labor organizing, or pursue careers in public service that might challenge corporate interests. This creates what economists call debt peonage, where workers become dependent on existing employers and unable to pursue alternatives that might provide better working conditions or wages. Student debt serves as a form of social control that maintains existing economic hierarchies. The debt also makes graduates more likely to pursue high-paying jobs in finance, consulting, and corporate law rather than careers in education, social work, or public service that might benefit society but don't generate enough income to service educational debt. This brain drain from public service to private profit maximization serves the interests of wealthy elites who benefit from having the most educated workers focused on generating returns for capital rather than solving social problems. However, there are strategies that individuals can use to avoid or minimize participation in the student debt system. Though success requires understanding how the system works and making choices that often conflict with social expectations, the most effective strategy is avoiding college entirely for careers that don't actually require college credentials. Many high-paying jobs in technology, skilled trades, and entrepreneurship provide better economic outcomes than college degrees without requiring debt financing. Trade schools, apprenticeship programs, and professional certifications often provide more job-relevant skills at a fraction of the cost of traditional college programs, while leading to careers with better job security and earning potential than many bachelor's degree programs. For students who do pursue college, choosing institutions and programs based on cost-benefit analysis rather than prestige or social expectations can prevent financially destructive decisions. Community colleges, in-state public universities, and programs with strong job placement rates provide better value than expensive private institutions or programs with poor employment outcomes. Working before college, saving money, and pursuing education part-time while employed can also prevent or minimize debt accumulation, though this approach requires longer timeframes and conflicts with social pressures to pursue education immediately after high school. But individual avoidance strategies won't solve the systemic problems created by the student debt industry. Comprehensive reform requires political changes that prioritize educational value over financial extraction and restore higher education as a public good rather than a private commodity. This means supporting legislation that allows student debt discharge in bankruptcy, caps university tuition increases, and eliminates the government guarantees that enable predatory lending practices. That also means supporting public investment in higher education that reduces costs for students while improving educational quality, following the models used successfully by other developed countries. Most importantly, it means recognizing that the student debt crisis isn't a natural result of educational costs but a manufactured crisis, designed to enrich financial institutions while destroying economic opportunities for students. The college system isn't broken, it's working exactly as designed to create maximum debt extraction while providing minimal economic value. Understanding this is essential for both avoiding the trap and working to change policies that prioritize financial profits over educational outcomes. Your student debt isn't the result of bad choices or irresponsible borrowing. It's the predictable outcome of a system designed to extract wealth from students while enriching banks and university administrators who profit from your financial destruction. The American dream of using education to improve your economic prospects has been replaced by a debt nightmare that makes economic advancement impossible for millions of Americans who believed they were investing in their future. But this isn't inevitable. It's the result of policy choices that can be changed if enough Americans understand what's happening and demand educational systems that serve students rather than financial institutions. The question is whether Americans will continue participating in a system that destroys their financial futures while enriching predatory lenders, or whether they'll demand alternatives that provide real educational value without lifelong debt. Slavery. College has become the biggest scam in America because it promises economic opportunity while delivering financial destruction. But understanding how the scam works is the first step toward avoiding it and creating better alternatives for future generations. The choice is yours. Continue feeding a system designed to exploit your desire for education, or choose paths that provide real skills and economic opportunities without requiring decades of debt payments to financial institutions that profit from your struggle. The student debt crisis isn't an accident. It's a feature of a system designed to create permanent debtors rather than educated citizens. But once you understand how it works, you can choose to opt out and pursue alternatives that serve your interests rather than the profits of lenders who view your education as a commodity to be exploited.